Hi, I'm Toby.
And I'm Nick.
And we're here bringing you the Pure Property Podcast from Track Capital, where we talk about everything property investment and property related. And our aim of the podcast is to help investors invest in property intelligently. This week, we're going to be talking about the stamp duty holiday, along with the current property market conditions that we find ourselves in, especially in these times of the global pandemic, which is a question we frequently get asked by many of our investors. And I suppose to start things off, quite an interesting time that we find ourselves in, Nick, as you all will know by the time this is out, we find ourselves going into a second lockdown on Thursday. Fun times, hey Nick?
Yeah, it's, to some extent, I think some people may have expected it coming, but at the same time, the government had us convinced on this regional approach, this tiered approach to the restrictions across the country. So whilst we expected some form of more intensity, I think a national lockdown not everyone saw, but as long as everyone's sort of safe and well, then we can't complain. But so today's topic, I think we're more focused on the, as you say, the stamp duty aspect, or SDLT, a form of tax, as many of you will know. So to kick off then, Toby, should we go into what exactly that is?
Well, stamp duty land tax is commonly defined as a tax on land transactions and property purchases. So it is paid on increasing portions of property price. So it's not the easiest to explain because it does come up in increments. So I would assume in the show notes we will put a link to the government website where you can see the increments and the different stamp duty levels, just to make it a bit easier. But to break it down for you, when you pay stamp duty land tax, you do pay it in the portions of the property price. So up to 125,000, you pay 0. Between 125 to 250,000, you pay a 2% on that portion. And then the portion between 250 to 925 is 5%. 925 to 1.5 million, on that portion there you pay 10%. And then if you're lucky enough to be buying for 1.5 million or above, you'll be then paying on that portion 12%.
Yeah, and it's that's obviously for the residential buyers, and we can't get too drowned in figures. But on the buy-to-let side, up to 500k, it's 3%. 500 to 925 is 8%, 925 to 1.5, 13%, and then over 1.5, 15%. So you are getting on the toppy side there.
Yeah, definitely. And that's the unfortunate thing about being an investor or buying a second home, is that you do, as you just pointed out, pay the extra 3%, so that goes up. But we're not here to be talking too much about that as such. We're here to talk about the stamp duty holiday that the Chancellor introduced early on in the year when we first had the lockdown. And he brought that in to help the property market and really to help keep prices propped up and make sure that we didn't experience a crash. As you know, when we first went into lockdown, different to this time round, property agents, estate agents, letting agents went into lockdown and had to shut as well. That is different this time around. When we go into the second lockdown, the property market remains open, so we shouldn't have the same problem as we did before. So the stamp duty holiday effectively means between now and the 31st of March 2021, you will pay 0 on property transactions that you do complete on. However, if you are an investor, you do still incur the 3% surcharge that you would have to pay anyway. The only thing you don't pay is the original stamp duty that you would pay if you're a normal homeowner. So if you're a homeowner, now you pay 0% up to 500,000. And if you're an investor, you pay 0% up to 500,000 plus the 3% that you would have paid anyway. So I suppose, Nick, with the stamp duty holiday, that's the definition, but what have you found that it's done for the market so far?
Yeah, so I think firstly it was a great PR initiative by Rishi Sunak and the government to bring that in. Overall, it just creates a bit of a buzz around the housing market, both for The residential side, people looking on the secondary market and physically moving house with their families, but also on the investor side as well. And there's obviously a lot of speculation and speaking about it from the agents and from the buyers. So to create a bit of a buzz was really helpful, and it did spur some people to taking action, which is always what we like to see. We don't want to see people waiting, 6 months and missing out on capital growth, missing out on rental income. It's really important once you find the right deal to move forward, and hopefully the stamp duty holiday has ultimately incentivized some people to do that.
Yeah, I mean, I know you mentioned it brought a little bit of a buzz to the property market. However, I would say it's more of a boom to the property market, to be fair. I mean, as you know, demand has been through the roof. If you take the house price index that came from HomeTrack in September alone, the UK house price growth hit a 2.5-year high, which is incredible. So for a period of time where we've got a global pandemic, we are going through tiered lockdowns, we're about to go in lockdown again, people are losing their jobs. The fact that property prices are still rising is incredible, to be fair. And I think this comes on to my next point, which is a conversation I've mentioned in a few of my weekly newsletters, that if you are looking to capitalise on the stamp duty holiday, you need to be buying a property now so you can complete before the 31st of March. And the reason I say that is because with the stamp duty holiday and the demand it's brought to the market, mortgage companies, mortgage brokers, lenders, conveyancers, they're all swamped and inundated with transactions they're trying to process. So anything you go to buy now or in the coming months, you have to remember you're going to be put into a very large pile. So average time frame of a property transaction, realistically, I think you'll be looking 3 to 4 months on an average. So what we're seeing at the moment is that is being delayed even more just because solicitors are inundated. As we mentioned, mortgage companies are inundated, so it's slower for them to react and be able to answer queries and do the process that is needed for a property purchase. So that's why I've been speaking to my investors, and when we're looking at some resale properties that we have on the market for them, I am sort of advising them, if you want the stamp duty holiday, buy now, because by the time you come to complete, because you have to remember it's on completion that you pay the stamp duty. It's not on exchange, which is some things sometimes investors do get confused about. It's on completion. So you can exchange on the 30th of March, but in which a lot of cases you can do. If you complete in April, a week later, you then don't get a stamp duty holiday.
Yes, I think overall it's just about being a bit more organised. As you mentioned, average timeframes can take up to 3 or 4 months. But if the investor's efficient, if they're using a half-decent solicitors, we can get things over the line in 4 to 6 weeks from reservation. So it's entirely investor dependent.
Yeah.
As long as you're, being efficient with your documentation and your responses, we can typically move things along quite quickly.
I think you're right there, and you hit the nail on the head. You have to be proactive. So as long as you've got the time and you've got the energy to be proactive and stay on top of your conveyancer, like you mentioned, pick a very good conveyancer. Stay on top of your mortgage broker if you're using a mortgage. If you're buying through an agent or an agency, if they've got a sales progressor, work with that sales progressor or whoever is progressing the sale. Just keep staying on top of it. Keep asking for updates and just try and being proactive in answering questions, getting paperwork back. And that is the main thing. But that said, it's been very interesting that a lot of the industry is actually calling out for the Chancellor to review the stamp duty holiday, because what they're worried about is come 31st of March, the deadline's going to hit, and then literally it'll be like the property transactions fall off a cliff and just stop. Now, I don't really see that being the case, but I can see where the concern is. So they are calling for an extension or a phase out of the stamp duty holiday just to try and stop that. Because if you think, I think it was quoted around 350,000 transactions could potentially be jeopardised, because if you look from a seller's point of view and a buyer's point of view, what could be at stake? If a buyer can't exchange and complete before the stamp duty deadline, that might be a portion of the money that they were hoping to help, do up a property, or they needed for the transaction. If that doesn't happen, then they might pull out. So if they pull out, then the seller loses a buyer. There could be a chain involved, so up and down the chain that's effective. So the amount of transactions this could affect if they don't bring something in to help ease it, I think it would be silly for them not to consider. So going forward, who knows? We haven't got a crystal ball, but they might look to extend that if needed.
Yeah, and I think people, whatever financial incentives there are from the government, as we've seen with furlough, the stamp duty holiday, etc., people are always going to ask for more.
Yeah.
I do ultimately think there will be a softening of the market come the end of March 2021. I don't think it's obviously going to stop dead. Obviously, people still need to move. I think overall is that we will see a slight softening of the market, but that's only sort of to be expected. And I think the other thing we need to put into context as well is when you're a buy-to-let investor, the actual financial difference from the from the stamp duty holiday in compared to the normal stamp duty rates at a lower level is typically not actually a huge difference. So if you're buying a £500,000 property, the most you can save with the stamp duty holiday is £15,000. But if you take some of our typical properties across Liverpool, Manchester, if we look at £175,000 example, if the property completes before the 31st of March next year, then the stamp duty rate would be the 3%, so £5,250. But if it completes after that period, it does go up. It is 3.6% as an average rate, so it works out at £6,250. But the point is, it's not, you're talking about a grand difference, and judging by the media headlines and the buzz in the market, you'd think it was, a life-changing amount of money. So, I would say, obviously, we are going to see that softening of the market come April next year. But in reality, have a think about it, look at the numbers and the data and see, is it really going to affect you that much if you complete before or after?
Yeah, I mean, just quickly on that point, like you mentioned, the market will soften. And I think when we say softened, the property price growth probably won't be as aggressive, but I think it's still going to be there, because even with a few people leaving the market because they can't get a stamp duty holiday, the demand's still going to be massively outweighing the supply. So I suppose on that point, probably would be wise to talk about what is the current market conditions we're in, Nick, because again, this is a question we get a lot of. So from your point of view, how are you finding the current market conditions?
Yeah, well, as we say, we're seeing the demand currently. We're obviously heavily investor focused, so we're seeing the demand from investors. What I would say is, when we're looking at and we're analysing the market, we're looking at sort of media headlines a lot of the time. We're looking at more data-focused organisations such as Savills, Knight Frank, HomeTrack. What are the experts saying on the market? What's their data, their evidence? What's that indicating? That's the real, evidence that should be used to form our decisions. So overall, if you read the media headlines, nearly every other day there's going to be a 10% drop or a 10% increase. So what I would say is look at the UK in segments as well. We don't want to be just taking the whole, every city across the country as a figure to go by or something to base our decisions on. So when we look at places like the Northwest, places like Manchester, Liverpool, Leeds, and if you come down a touch to Nottingham, based on the latest data, I think you mentioned HomeTrack earlier, Toby, but this is a company owned by the Zoopla Group. Now, these cities are still growing at between 4 and 5% per annum based on the latest data. So that goes to show you that there is still significant capital growth to be made, even in the current conditions. Now, what brings that the average UK house price growth figure down slightly is other areas of the country that are less well performing. So London is quite stagnant at the moment, so that's growing at a couple of percentage. But then you look at other places, so Oxford, Cambridge, 0.9, 1.5% growth per annum. So there's different areas of the country which are bringing the overall values down. However, if you look at the best performing, the tier 1 investment locations in the UK, in the Northwest, they're performing exceptionally well, and ultimately that's where we're seeing the demand come from.
Yeah, no, excellent points there. And I think a report that I came across quite recently, and I think we've mentioned in some of the figures we've been sending out to investors, if you take Savills forecast, for example, so they're now forecasting, obviously with the data they had through lockdown and how the market's been, they are looking at a 5-year forecast for the UK house price growth to be 20.4%. which obviously is incredible. And again, like you mentioned with the home track, that's brought down slightly to other areas of the UK. So if we take the northwest, for example, in England, that is what they're predicting to be the better performer at 27.3%. And even London, they've got at 12.7% forecast growth over the next 5 years, which if you think, that's incredible growth. If you've got a property at the property prices in London for how the market is at the moment, I think that's pretty good going. However, the front runner there, definitely from my point of view, would be the Northwest. And it's, again, a reason why we are seeing a massive demand from investors buying there at the moment, because the entry-level prices are low, the returns are good, and the potential future returns, not just in yield, but in capital growth, is exceptional, which I think is reason why they present an excellent investment case, in my opinion, anyway.
Yeah, so there's a couple of other things that I'd add to that. So, firstly, these sources of data, and generally when you're talking about the markets, people tend to group new build and off-plan investments together with the secondary market. So what you'll tend to find is the secondary market, i.e., direct vendors and individuals selling their properties, tends to be a lot more volatile and subject to these market conditions. Mm-hmm. So, with things like the furlough, a lot of people being laid off, yes, there are people out there that are dropping their property values, and there is opportunity to pick up really, really well-priced property on the secondary market. However, developers, especially cash-rich developers of a medium to large size, it's unlikely. Well, I know for a fact that they just don't drop their prices that easily. It would be fantastic for us if they would. Yeah. But what you tend to find is, even in the last lockdown, I think there was one developer that I saw that actually reduced their pricing. These developers, if they've got multiple sites going on, if they've got funds, they've already had sales prior to this on the project, they're not desperate. They're not going to suddenly drop all their prices and then, hope just to rush more sales in and then hope for the best. They're more long-term focused. They're looking at the overall result, the overall gross development value of a project, and ultimately their bottom line. So the only thing I'd add is, yes, it's important to consider the market conditions, and yes, you may be able to snap up some opportunities on the secondary market. However, if you're an investor sitting there now, you're looking at these prime apartments in the city centres, I wouldn't expect, or I wouldn't wait to try and get the bottom of the market or for the developers to drop their prices 20%, because it's very unlikely that will happen. However, what we can do as a company is act and negotiate on your behalf, and we can try and squeeze more incentives from these developers, get a bit more out of the deal. That's our job, and that's how we help investors. So there is opportunity out there, but it's not something that's going to cause huge significant drops in property values anytime soon on the new build market, in my opinion.
Definitely. And on that point, I had investors when we first went into lockdown saying they were going to wait to see what happened because they predicted property prices to drop and they wanted to pick up a bargain. I was telling them at the time, I don't foresee that happening because the fundamentals of the property market were still strong, meaning prices would hold out, if not increase. And lo and behold, back in March, the average house price increase, I would say, in popular and well-performing areas was anywhere between 2 to 4%. So they've potentially missed out on growth. So again, it just comes to the point of you shouldn't always sit in your hands. And I always tell investors the best time to invest was yesterday. But I think overall, the main thing we can conclude on and agree on, Nick, is the market at the moment is very buoyant, very strong and very stable, and it's only going up from here in the near future. Would you agree?
Yeah, I think providing you're getting the right deal in the right location. Again, we've just got to make sure we're segmenting the cities and differentiating them. Because if you're buying a city in the southwest, in the middle of nowhere, where there's limited demand, then you're probably not going to see huge capital growth. But yeah, looking at the current data, places as we mentioned in the northwest can represent a fantastic opportunity.
Definitely, and coming on to our next point, which I suppose we're going to have to bring up is, so we're going into lockdown on Thursday. We would have already been in it by the time this comes out. And I think the question that will be on a lot of people's minds when coming and talking about the property market is, well, what's this going to do to the property market? Now, Nick, as you know, what we've seen and what we're being told is the property market is still open for business. So from our point of view, nothing's going to change.
Yeah, it shouldn't be too much disruption for us, luckily, when we're in a very fortunate industry and in a position to be able to say that, because I appreciate, a lot of businesses will be affected. But I think the main driving one for us was the fact that construction sites can continue.
Yep.
and they can crack on, obviously, considering COVID restrictions and following the right regulation. But that's a big one, and I think the government recognise that. They need the continued for the jobs, obviously to keep the local economies going, etc. So that was really positive and something that will fill our investors with confidence. Because if a lot of people are purchasing off plan, etc., they want to know that their property developments is progressing. So that was the big one for me. And then obviously on off the back of that, property firms themselves are allowed to remain open, right?
Yeah, they are. Unfortunately, if most of them will be working from home, so that means I am stuck at home with my lovely wife and my kids. So I'm really looking forward to that, Nick. Of course, as soon as we can get back into the office, I pray and hope we can get back as soon as possible. Not because I'm not going to enjoy that time. Oh, it'll be magical, I'm sure. I'll just miss the office and you so much, Nick. That's why, definitely.
Well, I can't blame you. And you're going to be sat at home in your pajamas otherwise eating pizza. So, yeah, hopefully it won't last too long. Definitely.
Well, look, I think that's all we have got time for this week and all we're going to cover. We will be coming to you next week with our top 3 locations to invest currently. So we're going to be looking at mine and Nick's favourite top 3 locations to invest currently. And Nick, I'm sure you're looking forward to that one.
Yeah, no, that should be good. Something that we're always discussing, normally on the first call with investors. It's something that drives a lot of people's searches, i.e., looking at Manchester or looking at Liverpool, looking at London. At the end of the day, the UK has a housing target at the moment of 300,000 homes to build a year. So there is development opportunities in lots of different cities. And the government, Robert Jenrick has shown that that's still very much a focus. So we are going to continue to see building and developments available, and with that comes opportunity for investors. So yeah, next week we'll go over a few locations that me and Toby I think will be where we would put our money, or where we are putting our money, and how you can benefit from that too.
Excellent. So next week, top 3 locations. We look forward to you listening to us then. That's Toby and Nick from the Pure Property Podcast, and we'll see you next time.
Thanks guys, see you soon.